All right, I will we'll go ahead and get things started. Welcome everyone to the Centrifuge Startup Series. My name is Eric Weissman, Vice President of External Relations with Centrifuge. Been here since the very beginning, one of the founding members of the team, and EY has been a founding member of Centrifuge since even before I got here. It was kind of a seed that was planted by EY and really facilitated a lot of the help, and they've been a great partner for ours ever since. So thanks to EY, shout out to EY. And Alana's been great to work with in opening up her brain and the brains of some other smart people to help entrepreneurs move forward, get them to the next lily pad in their journey. And that's the whole purpose of the Centrifuge Startup Series. We changed everything to a much more virtual format with the events of the past 15 months. So this will be recorded. This is being recorded. So if we go too fast or you want to jump back in and remember something, you'll get a link to that recording, and we'll keep that alive for everybody to see. But when we decided at the beginning of this year to really divide up our programming into 6 categories that we were hearing from our startups of some of the skills and the knowledge bases that they needed to move forward, leadership development, hiring a team, marketing and sales growth, but financials and how you run a business and make sure that you stay on the tracks was one of the biggest things. And there really is, again, no better partnership that we have than with EY to help talk through some of that stuff. So if you're new to Centrifuge and are interested in becoming a Centrifuge member, I would direct you to our website. Talks all about Centrifuge membership, access to programming just like this, like this one. If you're interested in, and if working from home isn't working for you, you're more than welcome to work with me at Union Hall, 38,000 square feet of space that we keep right in the middle of OTR in this Central Business District of Cincinnati. So we have day passes starting at $25, $100 a month. I don't want to sell too much, but we got a lot of bandwidth and a lot of space to accommodate. Again, if you're tired of working with your dog, well, you can bring your dog here. That's fine too. We'll do that as well. So with no further ado, I want to turn it over to Alana and talk about, again, the importance of financials and financial modeling, and just thank her for her time. And thanks, EY, for your continued support.
Thank you very much, Eric, and welcome everybody today. As Eric mentioned, so our subject today is on projecting the future and pitching your plans with financial models. So everyone's favorite topic when we talk about accounting and finances and taxes and forecasting. So my goal today is try to make this a little bit maybe easier on everyone and kind of simplify this complex process. So to give a little bit of an overview, maybe I'll give a brief introduction. As Eric mentioned, my name is Alana Albers. I work for EY and have been here my entire career. So I've been with the firm for about over 13 years now. And I personally have spent the entire time working in our tax department. As glamorous and exciting as that sounds, thankfully, in the last few years, though, I've also had the great opportunity to start being able to shift that a bit and work with a lot of the entrepreneurs and startups, especially at Centrifuge. So this is a topic that, while this might not be the most exciting on the surface, I have seen a lot. So I'm really hoping to even kind of share some best practices today, some do's and don'ts of things that I've learned through seeing startups make these mistakes. And so I'm really hoping I can be here to kind of be a resource for you. So again, this is really kind of meant to be a topic to just kind of think about, again, what is the financial goals of my company? Are we potentially looking for investors? Are we hoping to offer a new product or maybe offer a new service through our company? Maybe we are curious to know, when are we going to be profitable? At what point are we going to break even? These are all great questions to ask, and financial modeling is kind of the answer to a lot of these. So we'll dive right in and get started. So this slide gives a little bit of an overview of our session today. And this nice little pyramid that we have kind of summarizes some of the topics that we're going to discuss. So we'll kind of even give an overview of financial modeling in general, especially if this is a topic that you're not overly familiar with. And then some of the main questions I get asked so many times are, okay, I know I need to create a model and I know the importance of it, but how do I start? How do I even project what types of revenues or expenses to consider? We'll kind of go through some of those steps. We'll talk a little bit about valuing your company. And then finally, the tip of the iceberg at the top, what happens now when we're looking to seek investments? How can we especially do this in this new modern age of the virtual environment that we have? So we kind of list the game plan off to the side here, and I kind of touched on some of these. But the one thing I will stress that I kind of mentioned at the very beginning, if some of you were online, but feel free to ask any questions that you might have. As Eric mentioned, he's going to keep an eye on the chat. So you can feel free to ask any questions during the chat, and we'll be monitoring that because I'm happy to answer anything that I possibly can. One thing I will say before we kind of even just get into the basics of this again is just keeping in mind that, again, financial modeling, a lot of people kind of view this as a bit of a tedious task, but I would tend to argue that this is one of the most important things that you can do as a company to really kind of help to ensure long-term success or future success, I will say. One of the big benefits of being able to do this is when you truly put pen to paper and kind of write down some of these numbers, you can start to kind of form some assumptions that you might have in your mind. You might start to notice some trends that take place amongst your company. This really helps you be able to take stock of where your company currently is and also gives you the opportunity to set some goals, whether they are short-term, maybe within the next year, or long-term, whether we're looking a few years out. So again, we'll start with basic financial modeling 101, meaning what exactly is financial modeling in the first place? So the true definition that we list here is financial modeling is the process of creating a summary of a company's expenses and earnings in the form of a spreadsheet. We want to put this in Excel that can be used to calculate the impact of a future event or decision. So essentially, this is developing a financial plan in Excel for our company. Many times as individuals, we hear that, oh, there's such an importance of setting a personal budget so that you can achieve your own personal financial goals. That is no different when it comes to a business or the startup entity that we're working with. Being able to put these numbers on paper and develop some of these goals is truly important. So let's even kind of talk about what are some of the other reasons that this is important. So it can help us estimate the value of our business. So many times startups say, well, I'm looking to seek an investor, but I have no idea what my business is worth. This is a great way that once we put numbers on paper, we can kind of just notice trends. Like I said, if we notice that at the very beginning of the year, we're selling maybe 50 products a month, and by the end of the year, we're selling 500 products, we can show that our growth is increasing, and this can kind of help us establish a value that we can show that we have tangible proof that our value of our company is going up. Secondly, modeling can help us calculate the cost and price points of new products. So again, if we're looking to kind of enter a new market, offer a new service, many times one of the questions we really need to ask is this going to be worth it? Essentially, what is our break-even point? How many of these new products do we need to sell so that we cover all of our costs and start being profitable? Modeling this out is an easy way to be able to kind of help establish this. Again, this helps us approximate our sales growth and net income. So maybe you're like, you know what, I've been investing in this company. At what point am I going to be able to take some money out and reap the benefits myself? Maybe if we kind of can show what is our income going to be, this will help us predict some either shareholder dividends or distributions that we might be able to take advantage of. This is also used in strategic planning to test scenarios. I think one of the misconceptions that I tend to see a lot is many startups and entrepreneurs think that financial modeling is just something that happens when you're brand new. This happens once. It only happens for like smaller companies. I can tell you from 13 years of working in tax with some of the largest companies in Cincinnati, all of these companies are still continuing to do financial modeling. Specifically around tax now, there's been a huge rise in this recently because so many companies are interested in, Biden's possibly going to increase corporate tax rates, or some of these incentives for high net worth individuals might go down. They're asking us, how are we supposed to plan for this? The answer is we set up a model for these companies and kind of predict out, well, what happens in this situation? What happens in this situation? So again, this really can kind of help you test scenarios, whether they're related to changing tax rates, changes in your material supplies. Again, you can kind of copy and paste and make a variety of models under many different assumptions. And then finally, this helps us decide on budgets and company resources. Again, if we're showing that our company is growing month after month, at what point do we decide, you know what, we probably need to take on some new employees, or maybe we do need to invest in some new software because we can see these trends that are taking place in our financial models. So these are just a few items that I would say to really kind of stress the importance of financial modeling, but again, super important in my opinion. So again, a bit of an overview. So a meaningful model should always incorporate uncertainty under various scenarios. So like we said in this last slide, we can test this for multiple scenarios. We shouldn't also just think, well, what happens if maybe tax rates increase? Or again, what happens if we work with this supplier? We really want to kind of even just test different models based on kind of a worst case scenario up to a best case scenario. One thing I would say that I've really seen in practice with these is I would suggest in a lot of these situations trying to just err more on the conservative side rather than on the aggressive side. And what I mean by this is when we create a model and we say, okay, now we're going to update this for our best case scenario. We are not talking about the situation or the once in a 10 million chance that our company goes viral and we suddenly just shoot off to the moon in terms of sales growth. While that's a great thing and we should always be dreaming and having high aspirations for our company, the chances of that happening are still very slim. So essentially in all of these scenarios, I would suggest that we still kind of keep a realistic mindset going to really kind of analyze, okay, this might be our best case scenario, but what are the chances of it truly happening? So in my personal opinion, when we're setting up a model, maybe our worst case scenario and our best case scenario, maybe there's a 10% chance of each of them happening. And then maybe the downside scenario and the upside scenario in the middle, that's the remaining maybe 40% chance of each. So again, we don't want to be overly optimistic, but we don't also want to be overly pessimistic. The best kind of real life situation that I can kind of throw out here is, I know I was working with a startup once and we were predicting their financial model and what they would potentially be worth. And this company, God bless them, they had great aspirations for their company, but they were showing that within 5 years, they would have a net worth of greater than Apple. And, kind of being the I'll say, accountant that I am, I tried to give a little bit of professional skepticism to the startup on this, saying, I'm not saying that that could possibly never happen, but the chances of you being able to go from a net worth of 0 to, billions of dollars within 5 years, the chances of that are just going to be very slim. And even if it possibly you think in your mind that it's going to happen, it is super unlikely that an investor is going to be on board with that. So again, another reason that we should have various scenarios, but again, we want these to all be realistic. Which kind of brings me to that point that's bolded right in the middle. A financial model is only as good as the inputs and assumptions that go into it. So keep in mind that there's always going to be uncertainties in our financial model. However, these models should not just be a true prediction. Granted, we don't really know. This is our best guess estimate of what will happen, but we should really make a commitment to establish targets and milestones within these scenarios that are realistic and actually have the chance of happening. So just because we have it in our model and it's on paper does not mean it's going to happen. We need to back up these models with facts. So let's kind of start now on concept number 1. So, okay, we've kind of got the big picture of what financial modeling is. Now, exactly how do we go about forecasting what goes into a model? So the very first topic that we're going to highlight on is revenue forecasting. So I kind of like this top point here, start simple and build from there. I tend to see, again, a lot of times that startups that are still kind of in the idea generation phase, they'll say, oh, I know exactly how I'm going to make my revenue. We're going to have subscription fees, and then there will be a bit of a tech fee on top of that. And then we might also have some delivery fees that go into this. That's great to think of these, but again, we want to kind of start big picture and then eventually nail into all of these details. So let's kind of go through some of these questions to really get us started. So first of all, when does your product reasonably launch? So many of the startups that I work with, again, are still working with prototypes, or they have ideas and they're not at the point where they can actually launch a product or a service yet. We need to think realistically and say, how long do we honestly think it will take for our product to be fully ready to go and that we can actually start selling it? Is it 5 months down the line? Is it 10 months down the line? Is it 3 years down the line? We really don't know. And until we truly know this, we have no idea when the revenue will start coming in. So kind of just knowing that launching point is a great goal to have and something we need to consider. Secondly, how will you charge for your product? Again, that seems straightforward and people are like, oh, I know exactly the price point. But there are so many different ways that we can charge for our products these days. Are you just going to pay one set point, online and ship it to your customer? Are you going to have subscription-based fees? That's rising in high popularity. Are there going to be possibly delivery charges or tech charges or monthly fees that you require if you're developing an app or something? So we need to think about that as well. Next, what is your market? And this first sub-bullet, are you a business to business supplier, or are you selling business to consumer? So essentially, are you kind of going to be a bit of the middleman? Or are you selling direct to customer? Again, if you're selling to a business that's then further going to sell your product, there's probably going to be a little bit of a markup that you might lose there. So just certain items to think, not saying that one option is better, but knowing these things in advance can be very beneficial. Are you selling locally, regionally, domestically, internationally, or globally? Around that, if we are selling maybe out of the country, are there any restrictions that we need to know in advance? I've worked with a few startups as well. One client in particular that they were going to focus their efforts in India. And we started truly asking, well, do you need permits or licenses, or are there fees for operating in countries such as this? And these were options they had never really considered at all. So kind of just knowing that can really help us avoid unnecessary expenses as well. Are you targeting specific age groups? Do we know what these age groups, what their spending habits might be? Are they more likely to buy from a brick and mortar store or online? Next, are you splitting your revenue with a partner? Knowing who's at stake here can be very beneficial. Yeah, we might bring in $1 million this year, but if I have 2 other partners, that cuts possibly my earnings down to a third. So keeping this in mind is helpful. What does your product life cycle look like? Is this something that's kind of a one and done product, meaning that, I sell this tangible product to someone and they're probably not likely ever going to renew or rebuy my product? Or again, do we have a subscription where maybe they continue to re-engage or renew their subscriptions each month? When do we expect this revenue to keep floating in? And then finally, the one question I see a lot of times is, well, I'm a brand new startup, meaning that there's not really any companies or anything that I can compare this to. So I really don't know how to predict my revenue. What should I do? Again, the best way to look at this is maybe just kind of take a step back and say, if I was an investor, how would I want to, what story would I want to hear that my startup entrepreneur has discussed with me about how they're planning to make money? Are there potential competitors that I can look for? Or even if there's no other company that's in the same market as me, are there other similar sized companies? Maybe just by talking to them or looking at their financials, I can determine what their rate of growth was. Doing some of this research, just even online, can be very beneficial to kind of get you a starting point. So as it notes here, you might walk away from this exercise with many questions that still need to be answered. Again, kind of just knowing these uncertainties is honestly a huge benefit. So before we start putting pen to paper here, or I should say typing into our spreadsheet, because we definitely want that for a model. So revenue forecasting continued. So what are some of the considerations when beginning a forecasting exercise? So we kind of show a little bit of a depiction here, but again, this is kind of taking all the questions that we asked on the last slide and just doing some of this brainstorming, maybe kind of writing them in a notebook, putting them into various categories. And again, the goal of this is to essentially plan revenue realistically and with data to support your numbers. We don't want to create revenue assumptions without having a story or a calculation to support the totals. So this again kind of goes with what I said before, that maybe we say, I have no idea at what rate of growth my company will possibly undergo. Are there some potentially, though, other factors or other stats that we can take in mind to help support this growth? For instance, maybe we have a company website and we have Google kind of tracking how many hits we have to our website each month. Are we slowly seeing that number potentially tick up? Maybe each month our hits to our website increase by 5%. If we have no other data to go off of, maybe we use that 5% as our goal for our growth targets. Similarly, do we have a Facebook page? Can we see how many friends or users are regularly visiting our Facebook or Instagram page? Maybe some of these trends can kind of help us get a starting point as well. One specific other item that I can say from real life, just like a scenario here that I thought was kind of ingenious, but I had a startup that I worked with that, without giving away too many details, they were focusing on a product that was meant for home sales. And in this situation, again, they were like, well, we're the first company to go into this. We have no idea of any other competitors that we possibly have. But they essentially started looking at trends of home sales. So again, was the market hot? Was it down? One thing they also had to look into was staging, because their product kind of related to what a home looked like on the inside. Maybe they took stock of how many realtors were staging these homes before selling them versus ones that were just, maybe taking pictures of an empty room and kind of posting those on Zillow. Just looking at some of these trends that might not necessarily relate to revenue, but can help support your story, can be super valuable as well. So again, we don't need to just come up with percentages off the top of our heads. Looking into some of the facts such as these can really be valuable as well to your investors. Okay, so now that we've kind of done our brainstorming and have listed all of our revenue streams that we're possibly going to have, all of our different ways of making money, all of our expenses or that we will charge to our customer, now we start putting these into a functional spreadsheet. So essentially, now that our estimates are complete, it's time to transform our work into a collection of facts that potential investors or potential business owners will find to be useful and can help them make some decisions. The one key item that I would note here when we are putting items into an Excel spreadsheet is that we want to use the power of Excel, meaning that we want to utilize formulas. So it's always a good idea to maybe kind of have an initial tab that includes all of our inputs. And then we have all of our scenario tabs that are completely formula driven, so that if we change some of the facts and circumstances, it automatically updates. So like one of the beauties of Excel is if we take, we expect to sell this many products a month and this is going to be the price point, we should always be setting up formulas in Excel to multiply those two rather than just typing in numbers on our own. We want Excel to be less manual calculation and more formula driven. And I see we do have a question in the chat kind of related to that. So is there a template in Excel for a financial model? It's important to model, but how is this important? So is there a financial model? So unfortunately, Excel doesn't have kind of a standard template related to this. However, I will kind of make a plug for EY here that if you are a member of Cintrifuse, this is something that we are happy to help you design with for free. Essentially, if you have also a financial model that you've kind of started with, but you're like, I'm looking to take this to the next level and make it look more professional, this is something we can definitely assist you with. I will also say, if you're not entirely sure how to get started on that, if you do a basic Google search, it will totally list out some of the main aspects that you need in a financial model. Just probably a data search or a Google search on what to include in a financial model can help you kind of design or figure out how to design your template. So unfortunately, there's no clear-cut answer on that. But again, there are plenty of ways to set one up, and there's no perfect black or white answer on this. You can kind of be as creative as you want. You want to make it look visually appealing to the user or your investor that might be analyzing this. But again, there's no clear-cut approach, and you have to kind of tweak it to your own company as well. Let's see. So with that, we will go into some of our last revenue forecasting additional tips that we have here. So the first bullet point, forecasts are estimates. These will change over time. And variances sometimes, if we see these, can be early warning signs of potential trouble. And what by that is what I mean is that if we set a forecast and we say, you know what, we're going to grow 5% month after month, and we're 5 months into that forecast, and we notice that we're only growing at a rate of 3%, it's probably going to be time then to change our model and maybe adjust that growth rate downwards. Also, if we see that we're not growing as fast, are there some reasons for that? Is there something taking place in the market? This can kind of help us take stock of maybe some challenges or market trends that we might not have, or that we might have been oblivious to before really putting into these numbers. So focus again on the big picture questions, and again, work your way down to the detail and the specific numbers. So I will mention that as well. The next bullet point, avoid the hockey stick. Well, what the heck are we talking about here? For those of you that are not aware, the hockey stick is essentially, we say, you know, we're a startup, we're flat because we don't have any revenue at this point, but our product is ready to go. Once we release this product, our sales, our profitability is going to skyrocket straight up. So essentially in the form of a hockey stick there. Again, the realistic chances of this happening are probably going to be pretty slim. There's probably going to be a lot of upfront expenses that we as a company have incurred before we can even launch our product. So it's very likely that we're still going to be operating at a loss for months, potentially even possibly years into the future before we become profitable. And even then, it's probably unlikely that, again, our sales are just going to shoot through the roof. Instead, it's probably more likely that we should shoot for steady, reliable, stable growth as we grow as a company. And then finally, consider economic factors into your model. So they mention here inflation and demand, but one perfect example I can think of that happened to us in the past year is COVID. How many of us predicted that COVID would happen? This is likely a scenario that we would have never built into our financial models, which understandably so. This is something that happens, we say, once every 100 years or so. But again, knowing that once COVID kind of struck, this is the perfect time that we say, you know what, we probably need to want to take restock of our financial model and adjust it probably downward. We probably can't assume that, you know, our optimistic model is going to stay the same. So if we start seeing kind of market trends such as this, we definitely need to update our model. And one other thing I will say that I've seen kind of startups, a mistake that I've seen startups make is they will come up with a model, they will maybe possibly have EY review, we will provide some suggestions, and then they don't ever touch the model. This model should be updated regularly. I would even suggest at least once a month to put in your actual data and then adjust your forecast going forward. The next month, update for the actuals and adjust going forward. Plenty of times we see companies that we've helped them design a model, and then a year later they come back and say, oh, my modeler has changed. I really need you to help with this. This is not something that you should be relying on a third party to update. If you're not understanding the model, the Excel yourself, this is worth making the investment to truly understand how the numbers are working in this calculation, because again, this is something you or your team should be updating quite regularly. And again, this was mentioned before, but what you don't know is just as important of what you do know. So monitoring these consumer trends, maybe we don't really know what's going to happen in the market, but kind of listing this as an assumption and maybe something that we have to monitor can be valuable going forward. What are some of the buying trends and the buying habits that we've seen? I actually have a friend of mine that started a brand new restaurant down in over the Rhine here. And he had, I'll say, 2 different restaurants, and one was kind of focused on, I'll just say, seafood related products, and one was more on kind of a Nashville hot chicken style model of products as well. And he tended to notice that one of the restaurants did much better in the summertime, probably the seafood one, whereas one did much better in the wintertime, the hot chicken one. He had no idea about this going into starting these businesses, but kind of knowing this over time helped him be able to kind of predict that, hey, we're probably going to have a more of a busy spell in the summer for one and a slower time in the winter for the same one, and vice versa for the other restaurant. Kind of knowing these things helped him adjust his financial planning over time. So let's switch over now into expense forecasting. So we kind of have gone through, okay, we know what revenue we're going to earn, but how do we start estimating our cost? Same thing as revenue, start simple and build from there. So the easiest way to do this is perform a current inventory of your current expenses. So if you've been having bills that have kind of piled up, or just that you've been paying regularly each month, it's probably likely these same expenses are going to continue on into the future. However, do we expect these expenses to fluctuate? Maybe right now we're working in our basement because of COVID and everything, but if we expect sales to take off, are we going to have to rent a potential space or maybe lease out some space at Centrifuge, something like this? Thinking about how these expenses might change really paints a more realistic picture in our model. Do we have staff, employees, or partners we need to account for? Again, if you and your partner are splitting revenues 50-50, it's probably important to ask that partner, what expenses have you been incurring on the side? Are there expenses that I am not considering as well? Secondly, what do you need to complete your product? So again, this is especially if you're in the design or idea phase of product generation and you haven't really gotten a full prototype yet. Again, do we need hardware, supplies, software to finish this? Once we have a good prototype, how much is it going to cost to recreate this product so we can actually sell it? Are there shipping costs we need to consider? Packaging cost. So these are things we really need to keep in mind. Do you need to hire outside consultants or contractors? Sometimes I've seen that companies have great ideas for new apps or something, but these are not coders or software designers. They're going to have to hire probably a third party to create this app, especially if they have no insight of IT. Have we estimated the cost of what it might take to truly develop an app? Because I've learned over time, those are a lot more costly than maybe I would have initially imagined. But keeping that in mind is something we should always consider. And again, do we need to build a physical prototype? Again, sometimes building these prototypes, there are multiple iterations of a prototype. So it's not a one and done type of approach. We might have multiple test runs and scenarios and training and testing that we have to do for these prototypes. Have we baked those costs into our model as well? And then finally, once we have a product developed, what do we need to truly launch this product? Again, what is our marketing or publications? We might have this great product, but who knows about it? How are we going to market this or advertise this? Are we going to try to advertise on social media? Is there a cost there? Are we going to come up with ad revenue, emails, calling individuals, going door to door to try to sell our products? Again, kind of thinking of these things will also help with our estimates. Let's see. Okay, expense forecasting considered. So again, we're going to do the exact same approach we did for revenue, where we're going to brainstorm this all out, and we're finally going to put it into an Excel model. So I do like this slide that it includes a lot of just, again, questions to kind of ask yourself. But I'll kind of say at this point, once we kind of have our Excel model, I know people were asking about some templates, but I'd like to share maybe some do's and don'ts of putting your data into Excel now. So again, what are some of the pros? I mentioned this briefly before, but we want to keep our Excel model visually appealing, meaning that we want to make it kind of simple for an outside party or an investor or something, make it easy for them to understand. Maybe it just is as simple as revenue, less cost of materials and cost of goods sold. What are our other expenses that we have? And then our profit at the bottom. We don't want to get bogged down on too many details and side calculations that it's almost just confusing and somebody can't understand our work. Again, visually appealing even as well. I know myself, I work with tons of accountants. We're not exactly the most creative people on earth. Maybe if you're going to be presenting this out to third parties, kind of adding maybe some bolding, some underlying, highlighting some key numbers. You know, we have, or Excel has conditional formatting where if your numbers are positive, they're in the black. If they're negative, they can go in the red. Adding some of these highlights can really be beneficial for outside parties as well. Another do or a pro tip is to round your numbers. Maybe you're very lucky and you're at the point where we're in, you know, making millions of dollars or something. In this situation, we probably don't need to put our numbers out to the exact dollar amount. Maybe it's time for us to start rounding in hundreds or thousands, something like that. Again, it keeps it a little bit more visually appealing and easier to read and understand. And finally, another thing to do is highlight key assumptions. So again, if we're pitching this to an investor, they might say, hey, I see that we are showing growth of 10% year after year. How did we get to that number? Having some of our assumptions laid out that, hey, we are assuming that the market trends for home purchases are going to continue on. We are assuming that the number of people that will get vaccinated is going to continue or reach this point so we can sell a particular mask product or something such as that. But having assumptions documented can help the viewer also understand this better. What are some don'ts that we don't want to consider? One big thing, do not use decimals. I do not care how small your startup is or if you just have some basic expenses. We always want to round this at least to the nearest dollar, no matter how small we are. So don't bog your spreadsheet down with decimal points. And then finally, once we have a model, and if we're going to pitch this to an investor, do not try to, I'll say, request significantly less cash than you might need, but also do not try to request significantly more cash than you might need. If you're showing this to an investor and you say, hey, we're predicting maybe $500,000 of expenses that we're going to incur in this first year, you want to go in then essentially looking for an investment of maybe that $500,000 and saying, well, I'd actually like to request $1 million because I'm going to need a stipend to survive myself. It probably doesn't look the greatest. So if you need to adjust your model for this bit of inflation or this security, now is the time you want to do that. Excuse me. Okay, again, so start inputting your expenses. So this slide just includes a few of what are some of the expenses that you might maybe overlook. So I kind of like how they list some off to the side, but while I was preparing for this, I started jotting down some of the expenses that I tend to see that startups have overlooked and have not considered at all when they're doing their model. One of the ones, and this kind of works for me since I'm a true accountant, but many people don't consider the cost of having an accountant, bookkeeping services, or specifically tax preparation fees. I've seen many startups that are operating as C corporations or partnerships, S corporations. The tax returns for these types of entities are going to be much more difficult than preparing your basic 1040 that you do for yourself and doing it in TurboTax or on the IRS's free website. Tax prep fees can be very costly, especially if you have lots of investors. So something to keep in mind there. Also, legal fees. I read in a Google article recently, they said if you are an investor, if you are a new startup, they actually suggested predicting 3 times the amount of legal fees you might initially expect. And I thought 3 times, wow, that's a lot. But some of the items that they mentioned that I'm like, okay, this is coming into more focus. But if you have maybe a partnership or a corporation, what are your company agreements? Registering a company's business name? Do you need business permits or licenses to operate somewhere? Applying for federal and tax ID numbers. Again, these are really kind of all legal fees that we might not consider when we're starting a business. Insurance is one that I've tended to see people overlook. I've seen businesses where we're going to have employees driving their cars around. Do we need car insurance on these employees? Maybe something to consider there as well. Data storage, that is something I've tend to see some startups kind of overlook. And then also one other thing I would say that I would consider is credit card transaction fees. Again, I've worked with some small restaurants and businesses that they say you don't quite realize how beneficial it is for your customers to pay cash rather than pay for a credit card, because those fees add up over time. So that's just a takeaway if you do have a business that's going to be highly operating on credit. So I saw we do have a question. So if I do have an investor and need 200,000, how much should I really ask for? So unfortunately, I can't specifically answer this question for you. We'll kind of talk soon that valuations and some of these modeling is kind of more of an art than a science. But again, I would say this is a situation where even if we think we need 200,000, maybe this is the situation where we do a model for, again, our worst case scenario to our best case scenario. Maybe if we're right in the middle and that's where we show we need the 200,000, does our worst case scenario show that maybe we would need 300,000? If so, maybe that's something that you can be transparent and mention that to your investor and say, you know what, if things go wrong and the COVID environment doesn't, pick up again right away, we might need this much. So I would just try to help support your numbers, or maybe even have a range to really kind of at least, again, give you some background data or support what you are asking for. So it might be a better idea, though, to be a little bit more conservative on what you ask. So maybe a little bit above the 200,000 just as a bit of a safety net. And in my opinion, I don't think it's a bad thing to mention that to your investor that, hey, we've included like a 5% extra that we need just for emergency use purposes or something such as that. Or if we're borrowing this much, are there options to set up a line of credit if we would need this funding? So I would just say there's multiple scenarios that can be worked through there. And some additional considerations for expense forecasting. So this kind of notes here that especially in the early stages, again, it's probably going to be easier and honestly, probably more important to be able to accurately estimate our expenses over our revenue, because at this point, we kind of know what our expenses might be or have a better idea. It's kind of hard to predict our sales growth. Again, we kind of discussed this a little bit, but what do we need to purchase or spend to launch our product? But the third bullet point is important. Which expenses are going to stay fixed and which ones are going to fluctuate with the business? And these are referred to as fixed versus variable cost. Fixed are types of expenses that regardless, they're not really going to change. So our monthly rent, we don't expect that our landlord's going to instantly double it in month 2. It's going to stay the same throughout the course of a year. Whereas our cost, if we're selling 50 products now, is going to be very different than if we start selling 500 products. Those are variable costs. So it's typically material supplies costs that relate to those variable costs. And this last one, I cannot stress this enough, expect that your list of expenses are going to grow with your business. So if you have a 10% growth rate, it's probably kind of reasonable to expect that your expenses are also going to grow at a similar rate. So we shouldn't just keep our expenses stagnant while our revenue continues to go up. So that is something that I've tended to see take place over time. And I see another question come in. So how important is it to let a potential investor know you are building a lifestyle company, not an exit strategy? I would say, in my opinion here, I will truly be honest that I would say if I was an investor, this is one where I would say like honesty is honestly the best policy in this situation. Maybe your investor as well would potentially be interested in a good exit strategy, at least if that's your end goal as well. I think kind of having, again, a model set up for that as well, just saying that, we predict to grow this company for 5 years. And then once we hit maybe this valuation point, that is when we want to focus on a potential buyer or an exit strategy. And we want someone on board that can help us grow and get to that point so that we're both profitable. Honestly, in this situation, I say it just depends on what your goals are as a startup, and conveying that ethically, honestly, to your investors can probably only benefit you in the long run. Great question. Okay, so we're going to shift topics a little bit from forecasting to more valuations. And this is something, again, I see a lot of questions on. So we see a lot of companies that say, I've been in business for a year now. How do I know how much my company is worth? Well, one thing I will start off by saying that it is very difficult to determine the accurate value of a company especially while it is in more of a startup phase, especially just because in the startup phase, we don't really know if the company will potentially succeed or fail in the years to come. Hopefully all of you will succeed, but again, this makes it more challenging because there's higher risk involved with valuing a company. And I will also say here, I kind of touched on this, but valuation is much more of an art than a science. So there's not really a specific formula that we can use saying, plug in your numbers into this formula and we'll give you the exact number that your company is worth. That's not the case. It's not black or white. So we'll kind of go through what do we need to consider when valuing a company. So I will say there's a lot of information on these next two slides here. And I'm happy to share these afterwards with you if you would like, but we'll kind of focus maybe on some of the bold points. But these slides really highlight 6 potential different stages of development of a company. So if you're kind of looking to how would I value my company, first look to what stage your company is in. So stage 1, this notes that there is no product revenue to date. There's even limited expense history, mostly because you're still in the idea, the planning, and initial product development stages. So again, we have this excellent idea for a company, but we haven't really been able to take it off the ground or materialize it yet. You are definitely in stage 1 then. Stage 2, the company still has no product revenue, but has started to incur significant expenses. They're starting to possibly develop their product. The product's not complete yet, but at least we're undergoing product development. So stage 3, at this point, we've made substantial progress in our product development. Maybe we're at the very tip of the iceberg in which our prototype is nearing the end. It notes here, development is near completion, but even in stage 3, there is still no product revenue, or if we have any, it's going to be very minuscule. We're not making substantial revenue because our product is not officially done yet. So it's kind of interesting, in my opinion, to note that stages 1 through 3, we're still not making any revenue at this point in time. So let's kind of hope that changes with stage 4 here. So stage 4, the company has started to make some product revenue, but again, is still operating at a loss. So again, we're starting to try to grow our business. We're trying to get our feet off the ground here. But again, we still have a lot of expenses. We're still paying bills for the product development. So all the way up to stage 4, we still have not earned any profit here. Stage 5, the company has, again, product revenue, and they are starting to break the point where they are operating profitably, or at least have some positive cash flows here. So it's only on stage 5 out of 6 that we're actually showing the company essentially in the black or making a profit at the end of the day. So again, this really shows how long this entrepreneurial journey can truly take. And then finally, stage 6, this is again, essentially an established company. So meaning that they still might even consider themselves a startup or an entrepreneur, but again, they're at least operating profitably. They've have proven success. We have a little bit of different valuation models for this late stage company as well. So let's again talk about how would we start maybe valuing these companies then. So the very first approach that we would take is sometimes known as the asset approach here. And this essentially uses the value of a company's assets to estimate a business entity valuation. So there's kind of some bad news here in the sense that typically if we're a startup company, we probably don't have a lot of assets at this point. Again, if we're operating out of our basement or something, maybe we haven't invested in a lot of technology or we don't have product development that's started yet. So how exactly do we go about estimating that? Well, another way to essentially kind of estimate the value is to kind of use a cost duplication method. And by this, investors will sometimes say, you know what, you have maybe a great idea, but we're going to kind of put you in the category of another company that we've dealt with as well. How much would it cost for us to essentially duplicate what you have currently done? So maybe in this situation, maybe you've invested 25 grand in expenses in, cost to set up a website, come up with a company name. You might have a great idea, but if you've incurred $25,000 so far, it's likely that an investor might kind of say, you know what, I could do the same thing and recreate that myself. So the value of your company is worth $25,000 at this point. So some of the downsides, in my opinion, of using this approach, again, why it's more of an art than a science, is this concept of valuing based on assets doesn't take into consideration maybe some great ideas. Maybe we have a 1 in a million idea that we say, you know what, we don't have any assets to our name yet, but this idea is worth millions of dollars. This approach doesn't take those great ideas into consideration. Also, again, these assets that we're valuing under this approach tend to be more physical assets that we can like touch and feel, like, again, computers, phones, software. This doesn't take into consideration intangible assets that we might have, again, such as maybe our company brand name that we've paid for. So that can be a bit of a downside related to this as well. One example I'll kind of give to this, though, this is kind of using that cost duplication method that I just mentioned, that if we've spent $25,000 on a company so far, and it's kind of likely then that that's the same value that a customer, or sorry, an investor might put that same value on our company. I've definitely seen a startup that I worked with before that I will just say it's kind of, again, initial naivety here, but he came to us and said, you know, I have a great idea for a company. And we said, you know, awesome, this sounds like a great idea in itself as well. And we said, have you started kind of thinking about how much money you'll need? And he said, honestly, at this point in time, he said, I think I would probably need at least $1 million to get this off the ground running. And we said, okay, you know, some of these businesses will take kind of a bit of an investment. And he said, yeah, I think for that, I'd be willing to maybe give up 10% of my company. So 10% for $1 million of cost is essentially putting a value on his company of $10 million. I will just tell you, it is very, very, very unlikely that an investor is going to put $10 million or value a company at $10 million when there is just an idea there. It could be a great idea, but again, it's very unlikely. So again, kind of taking a step back, does this make sense? How much money have I put into this business yet? If I really haven't put much into it yet, an investor might not really see the true value or the worth that I do as well. So again, something to consider there. The next approach we're going to talk about is this market approach. And this is essentially the approach of estimating the value of a business based on the selling price of similar entities. One thing I will say, one downside of this as well is sometimes, especially when working with startups, finding the value of similar entities at your same size can be very hard to find. Maybe this is where you need to kind of work with an accelerator such as Cinterfuse and say, you know, I'm really looking to kind of get some details on what other similar sized companies are valuing their business as, because this is kind of just one downside that can be difficult. Also, for startups, another downside of this approach is the price could potentially be lower as the investor is taking on more risk than investing in more of an established company. I've tended to see this, at least in Cincinnati, we have a lot of breweries that are popping up. Everyone wants to start the next brewery. That's great. That's awesome. I'm someone that enjoys craft beer, so I'll be glad to support you. However, if you are a brand new brewery and nobody has heard of your name, nobody has heard of your product, it's going to be hard to compare yourself even to a similar sized, entity that maybe has now had an established customer base. They've been selling their product for a little while. Again, because there's more risk involved. An investor says, well, how do I know that people even like your beer? Like, what's the chances? You could fail within a year. So again, that's something to keep in mind, that for startups, again, it's likely that investors might kind of value your company a little bit lower. So it's kind of the harsh reality that sometimes we do have to face. And then finally, we have the income discounted cash flow approach. And this is essentially for late stage companies that are generating revenue. And at this point, they're profitable. With this one, I'll kind of just spend a little bit of time on it, but it's essentially projecting their cash flow or their revenues that they're going to have over the course of the year and dividing it by their discount rate, or essentially maybe what is the rate that they would incur to take out a loan. This kind of does the time value of money and kind of helps predict what the value of the company is. So again, this is something that can be done much in the later stages of the game as well. So let's see, we do have about let's see, 3 slides left of pitching over Zoom. So I do want to say I'm happy to stay on if we do have any questions at the end, but I'll try to kind of go through these last few slides kind of briefly here. But some of these might sound like no-brainers. We've finally gotten our financial model done and we're ready to pitch to investors. This has been the year of pitching over Zoom, which has been great in many ways because we can do this near, far. We don't have to physically be next to the person to help pitch a great model that we have. But I've seen many of these mistakes happen. And again, these might sound like no-brainers, but you'd be surprised how many times these happen in real life. Showing up late. Again, none of us mean to do this, but I could not tell you how many times I've been in meetings with clients in which even partners or somebody from our own team or external parties have said, oh, I'm sorry, but I just didn't have the update of Zoom downloaded and it wouldn't let me log on and I had to restart. Always give yourself extra time to prepare for these technology glitches. So again, show up early and make sure the technology works. Being too casual. I would just say here, in my opinion, it is better to be overdressed when you are presenting to investors than underdressed. Awful background and lighting. So many people that I see sit with windows behind them. If you're one of them, I'm just giving you a heads up. This kind of makes you look super dark and shadowed. You always want light facing you. You want to give off a good impression and have a good face for your investors. I was also on a call once where I won't say the individual, but he said he was working from his son's apartment at the time because he was visiting. The son's apartment has never been more of a dirty apartment than I've ever seen. This might have been an opportunity where I would have said, turn your table around or your desk around and face a wall rather than facing an empty room with trash everywhere. So keep that in mind. Also, not looking at the camera. Many people tend to look at their side monitor. If you're making a pitch, you want to be face on to your webcam. Continuing to share the screen if you're done with the slides. Again, if you're in discussions with your investors, take the slides away. You want to bring in this personal approach to your meetings. Eating during a pitch, I think that comes with a no-brainer there. And we've probably all had to deal with this, but if you send a private message, I would just avoid these during your pitches because again, this can be challenging here. Not engaging your audience. It can be hard to read the room when you're in Zoom. Another reason why you want to take those slides off if you're working and having active discussions with many people. Monologuing, reading off the slides. I'll give you a secret. Even if you try not to do it, we can tell if you are reading from a slide because you can kind of see your eyes focus. So practice, be prepared for your pitch. And also not engaging your team. If you have team members, do introductions, get them to speak on a variety of topics. You don't want to come off as the know-it-all that is the only one that can really sell your product. This kind of puts less value on your team then. And again, some last minute ideas to impress the venture fund. Do the pre-work. So send materials before the meeting. I would even say send your slide deck before the meeting. I'm on a board and unfortunately, like I'll say our board kind of president is kind of guilty of, he'll send all the materials right before the meeting. So then when he kicks it off, none of us are paying attention to anything he's saying. We're just scanning over the materials. This is going to be the same thing that happens if you don't send materials in advance. So do that. Send your model in advance. Send your deck in advance. Do your research. Look up the person on LinkedIn. Look up their website. What background information should you know about them prior to meeting them in person? Giving yourself enough time, that kind of goes without saying as well. Making a connection. Connect first. Pitch afterwards. Even in this virtual environment, I cannot stress that small talk can do wonders. Embrace the dog that walks through the background or the kid that enters the room. This can really help break the ice. So again, making small talk can be helpful for you. Be conversational. Keeping the energy high. Again, you kind of just maybe you don't want that kind of a boring face when you're presenting yourself. If you need to practice, almost all of our laptops at least come with a camera option that we can show a video and practice ahead of time. Again, making eye contact, not reading from your script or looking at a different screen. And then finally, engaging your team. We mentioned this. Allow time for Q&A or again, kind of address these throughout the chat. Thanking your investors and then also coming back with what are our next steps? Do we plan to meet again? How do we go from here? Always having an end in sight is going to be beneficial. So with that, I think failed on my last one of pointers of significant time for Q&A, but I am happy to address any other questions that we might have. So Eric,
Thanks, Alana. No, that was great. That was fantastic. I really appreciate your energy and you dropping some knowledge bombs there at the end. That was great feedback. Yeah, well, if anybody has anything that that hasn't been covered, you want to throw that in the chat right now. Again, thanks for joining us. There'll be a survey following out immediately. So Catherine put that in. Catherine's my colleague here at Centrifuge. She put that in the chat right there, that SurveyMonkey link. But everybody on here will get an email upon the ending of the session. I thought it was great. And I mean, a lot of these things that you covered seem like basic, but I do think that it's important for everybody to keep in mind that demystify this a little bit. What's a financial model? What is this stuff? And you hear these words and you want to know what they mean and know how important they are to investors, but also your colleagues, to know that, like, this is the number we want to move. These are the numbers, and these are where our assumptions are coming from. So thanks for putting that together.
Yeah, no problem. And same thing. I'm happy to answer any questions afterwards if needed as well. Eric can definitely supply my email if you'd like to chat with EY, because again, we are happy to help you completely for free if you are a Centrifuge member.
Yeah. Great. Well, thanks everyone. I guess we'll wrap up. Catherine also put there a couple of the upcoming events that we have in the coming weeks. So look forward to keeping everybody moving forward, and appreciate your support and tuning into the Startup Series. Thank you.